Hi everyone, Professor Christensen here. Today we're going to do an overview of Chapter 6. So Chapter 6 is all about inventory and what happens in companies that have inventory. So they buy and sell things for a living. So we're going to take a look at what happens with the costs of inventory, how we report cost of goods sold on a multiple step income statement, so a new form of income statement. We're going to look at cost flow assumptions, which are very important. We'll see why. And then we're going to look at, again, these cost flow assumptions, what's important as far as tax and financial statement effects of them. We're going to look at how to record transactions using a perpetual inventory. So that's going back to debits and credits. And then finally, we'll take a little look at the ratios that we use to analyze inventory type transactions. All right, so first of all, let's recall what inventory is. Inventory is one of the only asset that a company holds just for the purpose of reselling, right? So the inventory itself is what is unsold, right? So those are items that are on hand unsold. So in a manufacturer, you can have three different kinds of inventory, which we'll look at, like raw materials, which are the things that you put together. So say you were making a bicycle, you would have tires to manufacture your bicycle, and the tires would be considered raw materials. Okay, so inventory of all types is reported as a current asset on the balance sheet. The cost of goods sold, which is exactly what it sounds like, it's the cost of the merchandise or the inventory that you sold during that period, is an expense on your income statement. So now most of the expenses you meet have the word expense on them. So sometimes students forget that cost of goods sold is an expense. So put that into your memory. Cost of goods sold is an expense even though it doesn't have the word expense. All right, so as promised, there are three different inventories in a manufacturing company. The raw materials, so that would be, like I mentioned, the tires for a bicycle manufacturer. Work in process is items of inventory that have been started, but they're not finished yet. So let's say you're making custom-made bicycles and it's partially assembled, but maybe the paint hasn't been finished yet. Or, well, it was probably painted to begin with, but maybe some of the parts haven't been put onto the bicycle yet, or the finishing touches haven't been put on. So that would be considered work in process. So those are inventory items that have been started but not finished. Finished goods, that's the final product. That's bicycle. That's the bicycle. That means it's ready to go, ready to sell to a customer. So if you have a merchandising company, or a wholesaler or a retailer, so say you're a Walmart, you are buying and selling inventory. You only have one account. Your account is called inventory. Okay, and we're going to look mostly at merchandising companies in our class because we look at manufacturing companies in more detail in managerial accounting. All right, so the inventories look like this on the balance sheet. So this is an example of Intel. They have raw materials, work in process, and finished goods, whereas Best Buy, which is a retailer, has only one inventory account called merchandise inventory. All right, so next up, we're going to look at cost of goods sold and the multiple step income statement. So the simplest way to remember how to calculate cost of goods sold is beginning inventory plus your purchases, which really is like your net purchases, minus your inventory equals ending inventory equals cost of goods sold. I literally remember being a student walking around saying to myself, beginning inventory plus purchases minus ending inventory equals cost of goods sold. And eventually I remembered it. All right, so let's see what that looks like. So beginning inventory is all of the stuff that you had on hand during the year. And your purchases are just what they sound like. If you think about, you go to the store and you make purchases, right? The purchases is all of the inventory that the company bought during the year. So if you add your beginning inventory plus your purchases, so here it's going to be $110,000. We call that cost of goods available for sale or inventory available for sale. So this company had $110,000 worth of stuff ready to sell this year. Now, where did that stuff go? Well, it went to one of two places, right? Either it's still sitting in your warehouse, so it's ending inventory, or, and before we go forward, remember beginning inventory plus purchases, 110, minus ending inventory of 30 gives us cost of goods sold of 80. Okay, so remember that everything that's available to sell is either sitting in ending inventory or it was sold. Okay, so this is a very important diagram. Make sure you understand this. And remember that beginning inventory plus purchases gives you cost of goods available for sale, and so does ending inventory plus cost of goods sold. All right, so this is what a multiple step income statement looks like. And if you look at maybe 10 different income statements of big companies, you can go to the SEC website and look at a company's 10K or a 10Q. That's their financials. You can see what their income statements look like. They're not all going to be exactly the same. But the idea of a multiple step income statement is that it has multiple levels of profit. Remember that an income statement shows you revenues minus expenses. So that has not changed. We're still doing revenues minus expenses. So revenues are added in, expenses are subtracted out. The difference here is that we have a bunch of subtotals along the way. So we start out with revenues, and this is net revenues or net sales, which means that we took out returns, allowances, and discounts. Revenues, net revenues, or net sales minus cost of goods sold gives you gross profit. And gross profit is the amount of money that's left to cover all of the other expenses of the company and then hopefully return a profit, a net income profit. All right, so from gross profit, we subtract operating expenses, and that gives us operating income. So this is the amount of money that the company gets. Remember, this is millions, that the company gets just from operating its business. And then there are some other revenues and expenses. So those are things that don't necessarily have to do with running their business. For example, they sold an investment or investments, right? They sold investments and they had a $3 million gain. They have some investment income, so their investments are providing them income, and then they pay interest expense. These have to do with how they're using their money, not how they operate their business necessarily. So those are called other revenues and expenses, or income and expense. Anything that's revenue or gain gets added, so these numbers here are added. Anything that's expense or loss gets subtracted, so the interest expense is subtracted. So here we have the 1854, we're adding those two, subtracting that. That gives us income before income taxes. Subtract out the income tax expense. It's a very important expense, often a big expense. Is at the bottom of the income statement, separate from the other expenses, and that gives us net income. So remember that it's still revenues minus expenses equals net income. All right, so now let's take a look at cost flow assumptions. And I chose to demonstrate cost flow assumptions. There is a separate video all about cost flow assumptions because implementing it is a little bit complicated, and I highly recommend that you take a look at that. But let me just talk about cost flow assumptions as it pertains to stock, because it's kind of easy to understand, I think. So if you bought stock, if you buy stock, right, which you very well might, and I hope you do in the near future when you get your full-time job, you will, if you buy stock at different dates, you're going to buy it at different prices. So here's an example of Apple stock, and let's say that you bought these amounts of shares on these dates. So on June 28th back in 21, you bought 20 shares. On November 22nd of 21, you bought 40 shares. Notice the price went up. Then on May 16th of 22, you bought another 30 shares. Now the price is down. So you have a total of 90 shares, and the total cost is $13,348.90. On June 30th, you decide you're going to sell 10 of those shares. So you sell the 10 shares, and at that point, the shares are selling for $137.82, and you get $1,378.20 when you sell your stock. Now, when you open up your account, this is what you see, right? You see you have 90 shares that cost you $13,348.90. Now, which 10 shares did you sell? There's no way to know because all of the shares look the same and they're all in the same account. You can't keep track of one share from another share, right? So what do we have to do? We have to make an assumption as to which shares we sold. And the same thing works with inventory because companies have inventory and you can't tell one item from another because they all look the same. So they make a cost flow assumption. They make an assumption. Now let's see what the three assumptions look like. All right, first of all is FIFO. And I remember learning about these. When I first heard these words, I thought they were very funny. But FIFO is first in, first out. First in, first out. What that means is the first ones to come in or the first ones to be purchased are the first ones to be sold. If we use FIFO, we're going to assume that the 10 shares that we're selling are from the first ones we bought back here. So we're selling 10 shares and they must have cost us this $139.96. So that means when we sell it for $13.78, we have a small loss. We have a little bit of a loss. So we bought the shares for $13.99. We're selling them for $13.78. So we have a $21.40 loss. All right, so that's FIFO. All right, another possibility is LIFO, which means the last ones to come in are the first ones to be sold. Last ones to be bought are the first ones to be sold. So in this case, we are selling these, the last ones to come in. So we're selling them and we're assuming that the ones that we sold cost us $137.59. So the total cost is $1375.90, 10 shares, remember. So in this case, we have a small gain. Now notice, this is the thing that you have to remember about accounting. A lot of people think accounting is black and white and everything is written in stone. Notice that two different companies can choose different cost flow assumptions, and even though exactly the same thing happened, the numbers are different, right? In this case, the company has FIFO. They have a little bit of a loss. In this case, the company uses LIFO. They have a gain. Same thing happened. They bought the same shares, they sold the same shares, but the numbers are different, right? So cost flow assumptions, one of many ways that companies can have different operating results depending on their choice. Now they can't make a different choice every year because of consistency. So they have to choose one and they stick with it, okay? All right, so the last cost flow assumption is average cost. And by average cost, we mean a weighted average. Because notice that we bought 20 shares, then 40, then 30. We didn't buy the same amount at each price. So the weighted average, you take the total cost of what you bought and you divide by the number of units that you bought, or in this case, shares. So we take the $13,348.90 divided by the 90 shares, and that gives us a weighted average cost of $148.32 per share. And we use that for all of the shares that we sell. So we use that as our cost. Now, notice we never paid $148.32 for a share, right? But that's the number we're going to use. So in this case, we're assuming that the cost was $1438.20. We sold it for $1378.20, so we have a loss of exactly $60. So a third completely legitimate possibility. All right. Okay, so remember that FIFO matches the flow of most goods, the physical flow. Remember that we're talking about inventory. It comes in and it goes out. What does the company usually sell? They sell the oldest things first, right? You're not going to sell the newest things first. But remember also that cost flow does not equal goods flow necessarily. But one of the advantages of FIFO is that it does match the flow of costs, a flow of goods in a company. Okay? And also ending inventory reflects current costs. And the reason it reflects current costs is that the newest costs are showing up in ending inventory because the oldest costs we're assuming were sold. Now in LIFO, cost of goods sold reflects current costs because we're assuming that the most recent ones are sold. And the reason that companies often use LIFO is because when prices are going up, and you'll see this when you do some of your actual inventory examples, but when prices are going up, LIFO is going to give you the lowest net income. Now, why does a company want to have low net income? Doesn't every company want to have high net income? Well, hopefully, if you're in the US, you're thinking, well, Yeah, for taxes, right? Lower net income equals lower taxes. So a company may very well want to use LIFO because it wants to pay less taxes, and GAAP requires this LIFO conformity rule. So if a company does use LIFO for taxes, it also has to use it for financial reporting. Okay, so next thing we're going to talk about is recording inventory purchases and sales, and this can get a little bit messy. So there's a separate video to walk you through the perpetual inventory transactions that we cover in our class. In periodic inventory, what that means is that the inventory account itself is only updated at the end of a period. So that means if you look at the books of a periodic inventory company, the inventory amount is beginning. It's the beginning inventory. They don't touch the inventory account until the end of the period when they close everything out. And they use this temporary account called purchases to record all the inventory they purchase. All right, so where I am, we study periodic inventory later on. We're not going to actually look at it in our financial accounting class, but we are going to look at perpetual inventory because most companies use perpetual inventory now. So in perpetual inventory, you debit the inventory account. You record all of your purchases and sales in and out of inventory. So you debit your inventory account every time you buy inventory, and you credit inventory every time you sell inventory or you return some. All right? So as a result, the inventory account in perpetual inventory always reflects the most current balance of inventory. Okay? Remember, periodic inventory, what's showing up in your inventory account is your beginning until you fix it at the end of the year or the end of the period, and perpetual inventory always perpetually shows an updated inventory amount. All right, so let's take a look at how companies might analyze their inventory. So inventory turnover is a very common way that companies analyze their inventory, and what it tells you is how quickly the inventory is sold. So when you calculate inventory turnover, which is cost of goods sold divided by your average inventory, and so there's another little calculation in there because average inventory is beginning plus ending divided by 2, a simple average, right? Beginning plus ending divided by 2. But when you divide cost of goods sold by your average inventory, you get a number, which is the number of times the inventory was turned over or sold in a year. Generally speaking, a higher inventory is better. Think about that. The reason is because what happens every time you sell inventory, you make money, right? Presumably you are selling your inventory for more than you bought it for, so every time you turn over your inventory, you're making some gross profit. All right, so average days in inventory tells you on average how many days of inventory are sitting in your warehouse. And in this case, lower is generally better, right? We don't want to have a lot of inventory sitting around because that's money, right? Money that's just sitting there. So the formula for this is 365 divided by the inventory turnover. And remember, that's going to give you the number of days, and that lower is better. Okay, then we'll take a look at gross profit ratio, also called gross margin. Anytime you see margin, what they're talking about is a percentage of sales or net sales, right? So gross profit ratio shows gross profit or gross margin as a percentage of net sales. Higher gross profit ratio is better. That means that you're making more money as a percentage of your sales every time you make a sale. So your formula is your gross profit in dollars divided by your sales in dollars. And companies might also calculate this just for a particular product, right? They might say, well, how much gross profit do we want on this product? And that might drive some of their selling decisions, their pricing decisions. All right, so finally, remember that gross profit is equal to, how do we get it? It's net sales minus cost of goods sold. Remember, we took a look at that on our multiple step income statement. All right, so that's all we have for chapter 6. I hope you find this helpful. Use the other 2 videos there, and they will help you with some of the details of the cost flow assumptions and the inventory transactions. All right, see you next time.